All right, well, we are looking at a positive start to the Thursday trading session. Some of that is based on the latest inflation numbers in the U.S., basically coming in line with what Wall Street's expectations were. Of course, everybody's so curious to know what happens on the interest rate front for the rest of the year, including here in Canada. And we'll get another taste of that from the Bank of Canada as we move into next week. For more on the market story, we're joined by Chhad Aul, Chief Investment Officer and Head of Multi-Asset Solutions at SLGI Asset Management. Good to see you.
Great to be here.
Okay, so we got a little economic checklist. I'm going to start with the U.S. because it gets a lot of the noise worldwide. Now, I should note that this inflation data today, which everybody says this is the one that the U.S. Federal Reserve loves to look at, it actually rose the most in a year, which maybe justifies why these central bankers have been reluctant to say, we're done, we're ready to cut.
Sure.
But the market seems satisfied with what we saw. Can you explain this to us?
A lot of that has to do with the fact that it's in line with expectations. And you're right, this is the PCE measure that the Fed likes to prefer, but the CPI measure came out earlier in the month, and that was a bit of a surprise. You'll remember, it was the one day the market really kind of sold off this year. So the market was braced for perhaps a hotter number than this even, and we'll take some satisfaction that we didn't actually get that. And again, January, you get a lot of noise, you get a lot of seasonal factors, et cetera, that can play with the data. But it's a good point that the patience from the central banks, perhaps not calling out a specific reacceleration in inflation data, but just noting that the downward path from here could be a little bit bumpy along the way.
Markets will take what they can get. I mean, is there almost a message in that the market is ready for a little bit of turbulence? It's been enjoying the momentum higher and wants to keep that storyline going?
Yeah, I think if you look at the bond market in particular, obviously much more sensitive to the interest rate outlook and inflation, there has been a notable reset so far this year, right? So we came into the year, the bond market pricing in as many as 5 rate cuts for the year, for the U.S., for Canada, around 5. That's kind of come back in line now over the course of this year to closer to what the central banks have been telegraphing themselves, closer to 3 rate cuts. So there has been a reset going on in parts of the capital market. The equity market has, for the most part, kind of chugged along in the face of that reset.
Well, speaking of chugging along, we also got this Canadian economic data today, and we saw some reasonable performance to end last year. We saw an early read for January that was also reasonable. And, it's interesting. We've talked about the resilience of the U.S. economy and spoke to an economist yesterday who felt like that's been rubbing off on Canada.
Sure.
I mean, how would you characterize the situation here?
Yeah, and I think a little bit of that rubbing off, you kind of get that if you dive into the details of this fourth quarter GDP data for Canada. A lot of the strength actually came from exports. And our biggest export market, of course, is the U.S. If you look at final demand domestically, so for Canadians, was actually a contraction in the quarter. So Canadian consumers, business are definitely still feeling the pinch. And if you drive into the data, you do see that underlying factor.
So let's then get to this interest rate story for Canada. We do have a Bank of Canada decision moving into next week. Looks like Bay Street's pretty much consensus. They are once again not expecting a change, but everybody's trying to figure out if that consumer story, that consumer weakness story that you talked about, is ultimately the kind of thing that could cause some damage. Right. At what point the Bank of Canada feels they need to cut rates. What are your own expectations right now?
I don't think they will do so until probably the middle of this year. I think they prefer to see the Fed go first. I think that this is one where most of the developed markets, central banks are going to wait for some guidance from the Fed now, unless things really deviate. You didn't see that in today's GDP numbers. So I think that what you will see, though, is where we saw a little bit more hawkish tone, whether it's from the Bank of Canada, a lot of Fed speakers trying to reset expectations through much of this year. Now that I think expectations are somewhat in line, I think you may see a softer tone for the Bank of Canada, something a little bit more balanced in terms of their approach. And I think call out the fact that there has been significant progress on inflation, and elements of the Canadian economy are certainly cooling.
Can we tie back the latest round of bank earnings in this country to this story? I was adding it up. The Big Five have set aside in their latest numbers close to $4 billion for a potential deterioration in their loan portfolios. Right. Now, these banks are global. Some of them have a lot of exposure to the United States. So there's, in this environment. A lot of things you have to be prudently prepared for.
Right.
But did you look at some of the provisioning and say, well, it would suggest that there are signs of weakness for the Canadian economy?
I think a lot of it is coming through from Canadian lending. And you'd expect to see higher loan loss provisions, but they've actually come in higher than expectations as well. So still points to certainly Canadian consumers, small businesses, seeing some weakness, and you've seen higher delinquency rates as well. So certainly monetary policy is working as expected. These bank commentaries certainly does confirm that.
So before I let you go, earlier in the program, I shared some numbers with our audience about how when you have up performance for stocks in January and February, it's a pretty good sign for the year overall. It's certainly true for the S&P. In the last 10 instances, it's generally been true for Canada. But I get a sense that you're positioning a little bit more defensively right now.
Yeah, I mean, overall neutral on equities within the portfolio, which means, again, at your strategic weight. So this is an environment where we're at a kind of a tipping point economically. Are we going to get that soft landing that everybody covets? Is it going to be a harder landing scenario, or is this going to be a reacceleration, so a no landing? The question is still out there, and the data is yet to confirm it. So I think within equities, you stay in the game, but perhaps under the surface, position for quality. So again, strong balance sheets in case you do see that economic weakness. Companies that have resilient earnings throughout the economic cycle. So avoid some of that cyclicality. Allows you to, again, participate very strongly, and again, gets you into some of these themes that have been doing quite well in this market.